Happy New Year! New Year means new goals, and maybe one of your goals this year is to save more money. And good news, today we are going to be discussing two of the best ways that can help you earn some of the highest interest rates possible on your cash. Additionally, I'll even give you the answer to a question I get asked every single day, and that is, which is better, brokered CDs or Treasury bills? And to fully answer that question, we have to start off with the basics, specifically what is a brokered CD and what is a Treasury bill. Now, brokered CDs are CDs issued by banks like Capital One that you can buy on the secondary market. Popular firms like Vanguard, Fidelity, and Charles Schwab can offer you CDs from hundreds of different banks across the country. And because these big brokerages partner with FDIC-insured banks, the money you deposit is also fully FDIC-insured. And the nice thing about brokered CDs is that they work the exact same way as bank CDs. If you hold it until maturity date, you will be paid all of your money back plus interest. For example, on Charles Schwab, you can buy a 1-year callable CD from JP Chase yielding 4.65% APY. So if you deposit $10,000 into this CD, for example, you'll earn $465 of interest when it matures. And this is much higher than what banks typically give you when you don't have a broker like Charles Schwab that helps you negotiate for better rates. For instance, if you buy a high-yield CD from Ally Bank directly, you can get, at best, 4.15% APY for a 1-year CD. Not bad, but that's 0.5% lower. In other words, that's $50 in opportunity cost for every $10,000 that you deposit. Plus, you have to open an account with Ally Bank, whereas you can manage all of your brokered CDs under a single platform while still remaining FDIC insured. That said, if you don't like JP Chase or you don't like callable CDs, you can also see here that there's a plethora of other banks to choose from. For example, you can get a really nice 1-year non-callable CD with Wells Fargo yielding 4.6% APY. You might also notice here on some of these that they say recently issued, and a lot of brokers will charge small fees on secondary trades, typically about a $1 fee for every $1,000 CD. However, they don't typically charge fees on newly issued CDs, which are the ones in bold. So for me personally, I typically buy recently issued CDs so that I can save on any fees. I should also mention that brokered CDs have an additional benefit in the sense that you can sell the CD before it matures. The value of your brokered CD will fluctuate depending on a lot of factors, including the size of your deposit, the interest rate environment like inflation, and the time until maturity date. So if you find yourself in a pinch where you need cash immediately, you could sell it early through your brokerage account. And another benefit is that you can deposit money with hundreds of different banks via the same broker. For example, I could put $250,000 into a brokered CD by JP Chase and another $250,000 via a brokered CD by Wells Fargo. I'd end up with $500,000 worth of FDIC insurance. And the key thing here is to remember that you must choose different banks in order to have that expanded FDIC coverage. Now that pretty much covers the basics of brokered CDs. In short, they offer some of the same protections as bank CDs, but they can also offer some potential benefits, namely higher interest rates and convenience. But now let's take a look at Treasuries, and this is when you lend money to the US government for a fixed amount of time. And because these are essentially government bonds, you can deposit millions of dollars and still be fully protected by the US Treasury. And the first advantage of Treasuries is the tax benefits. Notably, the interest you earn is exempt from both state and local income taxes, and this makes it very popular among high-income earners or those living in areas with state income taxes. And the second main advantage typically is the high yields, especially compared to a regular savings account or even a bank CD. For example, on Charles Schwab, you can purchase a Treasury bond that is maturing in 1 year and yields 4.718% APY. That's quite phenomenal, especially considering that we haven't even factored in the tax savings. Of course, you can buy short-term treasuries as well, with some maturing in as little as 4 weeks, and Treasury Direct typically is a pretty good platform for that purpose. For instance, the latest 4-week Treasury bill was yielding 3.9% annualized, which is actually pretty good. Additionally, you can even see here that the latest 26-week T-bill was yielding 4.8% APY. Very good stuff all around. So now that we've discussed the basics of brokered CDs and Treasuries, which one is better right now? Well, it's a little bit difficult to compare yields because brokered CDs are completely taxable, whereas Treasuries have those tax benefits. So how exactly do we compare those two numbers? And I would say that the easiest way to do it is by finding yourself a tax equivalent yield calculator. Now, you can do all of the math yourself by finding your federal and state income tax bracket and your filing status. However, Fidelity has this amazing online calculator for you already, and frankly, I like to save my time. So previously in this video, I found a 1-year Treasury on Charles Schwab yielding 4.718% APY. So for bond type on this Fidelity calculator, I'll put down Treasury. For the yield, we'll put down 4.71%. I'm on Safari, which is a bit annoying where you have to use the up arrow in order to type in your yield, but that's okay. For estimated taxable income, let's say that you make a very respectable $60,000 per year. We'll also put down single, and let's say that you live in New York. We'll hit calculate, and voila. Below, you'll find the tax brackets that Fidelity has calculated based on your estimated taxable income. We're hitting 22% for federal and 6% for state in this specific example. And based on those numbers, you can see that earning 4.718% on a Treasury bill is the exact same as earning 5.17% on a brokered CD when you account for those tax benefits. In other words, if your CD is offering less than 5.17% APY, you should pick Treasury bills because they are offering a higher tax equivalent yield. And if your CD is offering more than 5.17%, you should pick up the CD instead. Now, the 1-year CD that I found on Charles Schwab was by JP Morgan Chase, offering just 4.65% APY. Therefore, a Treasury bill would earn me significantly more money, and that's what I should go with. As always, you can play around with these numbers yourselves depending on the state you live in, your annual income, and your filing status. That said, if you think you may need to cash out your CD or Treasury before it matures, you should generally lean in the direction of brokered Treasuries or bank CDs since they're in a more liquid market. And if we are to make generalizations, this is typically how it goes. It's not the case right now because brokered CD rates are currently lagging a bit behind Treasuries, but generally speaking, this is the case. If you have no state or local income tax, brokered CDs are often better because they generally pay an overall higher rate. Now, if you have state income taxes but have a lower income, you should definitely consult the Fidelity tax equivalent yield calculator to see which one is better for you. And finally, if you have state income taxes but you also have a really high income, Treasuries are often better because they offer those tax savings. And as for me, I live in a state with income taxes, so I generally prefer Treasury bills. However, especially if I'm reinvesting my cash, I always consult the calculator to see which is better. As always, I love to know your thoughts and which ones you prefer. And of course, with all that said, have a great start to 2023. Let's go!